All right, emerging stocks are on fire this year, as you may have noticed. The MSCI Emerging Markets Index is up almost 40% year to date. In fact, the question now, have emerging market stocks come too far too fast? Our next guest says he still thinks emerging markets will outperform the rest of the world. Eduardo Levy-Yeyati is head of emerging market strategy at Barclays Capital. He is a former senior financial sector advisor at the World Bank as well. Joining us live from our Buenos Aires newsroom, Eduardo, welcome to the show. Let me first ask you about your outlook for the global economy. When you were last on our show in March, you said you thought that the recovery would be feeble. I'm assuming you mean the global economic recovery. Does it still look feeble, more feeble, less feeble?
I still think pretty much the same thing, but for a complete answer, I have to distinguish between the timing and the strength question. We believe that the recovery will be faster than originally expected, so that's positive. We do believe that in most quarters, the recovery will be dragged down by debt problems, the package with which many of these countries enter the crisis. So yes, I think that the recovery will be feeble, disappointing by historical standards, as comparing with past recoveries, but still will be there next year.
Yeah, but you're still bullish on emerging markets. Why is this? Will they do better than the rest of the global economic recovery?
Yes. Again, we have to differentiate. We are bullish Asian markets and Latin American emerging markets for different reasons, and we are a little more skeptical about Eastern Europe because, again, in the global map, we see Europe lagging behind the U.S., China in the recovery. So, but the broad answer would be yes. We still think that those two emerging market regions will outperform core economies looking forward, both in terms of growth and in terms of market potential, market upside.
Let me ask you, Eastern Europe, you differentiate, I'm assuming, from Western Europe because it looks like valuations here are higher than they are, or at least stocks look more expensive here in the U.S. than they do in Europe.
Yes, but my differentiation is based essentially on the same argument that is leading me to anticipate a slower recovery, which is a very important debt overhang that will be dragging down growth in both, to some extent, the U.S. but particularly Eastern European countries that went into a leveraging process, very sharp, deep leveraging process in the growth phase. Now they're still only gradually deleveraging. So, looking forward, again, it's not a question of relative value right now. It's more like it's more associated with a differential growth prospect. I think that Eastern Europe, because the EU will lag behind the US, but also because their own intrinsic problems will be the laggards in this recovery.
All right, let's talk about specific countries that you like, and I want to first look into Asia. What are your preferences in Asia as far as countries, and what do you think about China to start with?
We have been for a while, I have to say that, very optimistic in relative terms about China and China's capacity to engineer a fiscally driven recovery. What we are seeing in recent weeks is essentially supporting our original view. And actually, we have, at this stage, probably a positive upside to our growth outlook, which was originally above consensus. So I would say in China, we are simply seeing what we were expecting, a very powerful fiscal stimulus in a command economy showing very rapidly their effects. Now, this is spilling over to many emerging Asian markets, and also to some extent to Japan. But let's concentrate on emerging markets. I would say Korea, pretty much everyone, every country in Asia, but in particular Korea, I think, is poised to have an important growth and recovery, fast and solid recovery. Again, driven by, to a large extent, the bright Chinese outlook.
Do you think that some countries, and I mean we can focus on Asia for now, or look at it globally if you prefer, have done better as far as their stimulus injections?
Well, yes, definitely. I think that the fiscal stimulus, in terms of effectiveness, at least from what the data is showing us so far, has been most effective in China. Again, it is not unrelated to the fact that China is a command economy and has more strengths in the transmission mechanism to the private sector. In fact, we have to bear in mind that even though some of this recovery has been driven by government spending, for instance, if you look at the IP number, the surprisingly good IP number recently released, this is more broader based. So I think this is actually spilling over to the private economy. Second in this rank would be the U.S. probably. I think part of this fiscal stimulus, combined monetary and fiscal stimulus, is actually showing its impact.
Okay.
There is not so many other countries with important fiscal stimulus packages, really.
Okay, Eduardo, thank you so much for joining us. We have to take a quick break.